Of course, this is not financial advice and for entertainment purposes only. This one ETF crushed the likes of both VOO and even SCHG by a huge mile. Investors, yes, this one ETF called AOTG by AOT Invest crushed the likes of both SCHG, VUG, QQQM, XLK, ARC, and so many more. It literally is so underrated and it's crazy. So then I reached out to the founder, CEO, and portfolio manager of AOTG ETF, that of Mr. John Tinsman, to explain how the heck he's outperforming both the S&P 500 and even the NASDAQ 100. He's literally beating the market with this ETF and it's absolutely crazy. So in this video, John Tinsman gives his reasons as to why this ETF of AOTG, which is a growth ETF, outperformed so many other ETFs like VOO, SCHG, XLK, etc., why it's outperforming, even a full review of his ETF, and so much more. You'll also learn how he invests to beat the market, to actually beat the stock market, which is amazing. It's so much value all in this video for you guys. So if you love individual stocks or even how to outperform the market, this video is just for you. So if you will, please welcome Mr. John Tinsman, the founder, CEO, and portfolio manager of AOT Invest. Where they have an ETF called AOTG, their AOT Growth and Innovation ETF that has been taking names on Wall Street, having such great performance and outperforming some tickers that you guys might know of, such as SCHG, VUG, XLK, and ARKK, even the S&P 500. It's phenomenal how you guys are doing this. So I'm going to throw it back to you, John, on how you feel about being on the channel and just about the performance lately of your product of AOTG for investors.
Thank you for having me here. It's a pleasure to be here with you today, Marcos. I mean, you have a great channel. I love the educational content you put out. I've watched plenty of your videos. I think investments are a judicious decision, and the more content and the more education investors can have when they make that decision, the better. So I think you're doing a great thing for everybody. I'm excited to be here to talk to you about AOTG, because a lot of this comes down to the differences between like a fund like AOTG and the leading indexes that you're comparing it to. And I think I started this fund to invest with my own money. I have my money all in my own funds. So I'm a very big believer in this. And mathematically, a lot of research, backwardated research, quantitative research went into this. And it's very compelling. And when I tell it to you, I think you're going to realize, this is common sense. Like it all makes sense when you hear it. And you'll see that the performance backs it up now too after the first 3 years. So thank you for having me here.
AOTG is a high quality growth portfolio embracing low marginal cost companies. AOTG has been one of the top performing long only diversified equity ETFs over the past 3 years and has an over 100% return of track record. And like I said before, taking out so many names in the market. Can you provide a brief background on yourself, including AOTG Invest, and why you guys launched AOTG for investors?
I've been doing investing, since I was little. It's always been an interest of mine. I went to Northwestern and University of Oxford. I studied economics and particularly took as many investment classes as I could while I was there. And over that time, I also enjoyed investing with my own money and even for my parents and my brothers. And I kind of liked buying the Visas and the Microsofts and the Googles. And so in some of these investment classes, a lot of times people would tell you there's no way to do better than the indexes. And yet, if you bought Microsoft or Facebook or Google or Amazon or Visa at any point 5 years ago, 10 years ago, 20 years ago, the further back you bought them, the better you did, and you did a lot better than the indexes. And so there was a question of why? Why did this happen? And I really wanted to do a deep dive into this because I was already doing this for myself and my family. Eventually the investment performance was very good and the amount I was investing grew. And so it made sense to launch an ETF. ETFs are really good for investors, including myself, right? One of the reasons for that is the tax efficiency there, Marcus. The tax efficiency means when you sell when a fund manager like myself sells holdings, whether it's NVIDIA or Google, and they've gone up by 1,000%, the shareholders of the fund don't get a capital gains tax bill. So then the fund manager can reinvest that, say into AMD or something, and it can continue to appreciate for years or decades. The only capital gains bill that gets recognized in ETF is when the investor itself sells the ETF, right? So there's this tax efficiency thing is really good for investors. It helps them maximize their long-term performance, which I think is what you're all about and why you like ETFs. And it's wonderful that you put that, educational content out there because most people don't even realize it. I realized it too late. I'm embarrassed by that. And then like my research I did and why I came up with how you can beat these indexes is like, I don't like you mentioned like the SCHG, right? Like, do you know how that fund is run? It's basically only by market cap. Like, I don't think the growth has to be very high to qualify for it. And so basically what you do is you look back at what they do is they look back at the last 3 years and they look back at the present and then they make some projections for the future. Like you have like top holdings like, Apple, which are barely growing faster than inflation. And they're like a 9 or 10% weight. And so it's not really like a growth fund. I like to call them the not shrinking funds, which is good, right? It doesn't always make sense to just weight by market cap, especially once you're already focusing on the large cap names. So like, I think there's some sense to avoiding some of the small cap and mid cap companies. Marcos, if you pull up like the Morningstar chart, you'll notice, right? Growth has done better than value, right? Over 5 years, 10 years, 15 years, 20 years. Then what's the next thing? That large cap has done better than mid cap and small cap over the last 10 years, 5 years, 15 years, 20 years. You'll also notice that technology has done better than small cap, technology has done better than any sector over the past 5 years, 10 years, 15 years, 20 years. And so then you're like, wait, like I've got all this. Like, why don't I just have like a large cap technology growth fund? And that's exactly right. Like it's pretty hard to mess that up and you can have really good performance. But then the thing is you can still do better than that. So what I noticed about like these technology and growth funds is I like to target low marginal cost. Okay, so low marginal cost is how much it costs to produce one additional unit. So like if you were to think about like how much does it cost Microsoft for one additional unit of Microsoft Office, the cost of that production is zero. So basically they can sell it at 100% profit margins when there's new incremental sales and demand. This totally changes the risk reward for like investors because any growth, one, it's not funded by debt. Like the opposite I like to compare it to is a company like Boeing. Boeing is like, if they were to scale the business, they have to build new factories, they have to build a new supply chain. It's very, very expensive. And a lot of times it comes at negative profit margins because it's just so expensive and it's funded by debt. The opposite of that is a low marginal cost company that could grow without debt with high profit margins. And that's really good for investors to own. And it changes like NVIDIA is earning 18 times more than they were 2 years ago. And like that is not possible to do in the traditional industries. It's possible in a low marginal cost business, but like you said, you have that big fat tail reward that you really want to have in your fund. Weighting the portfolio, not just on like market cap, but weighting it on low marginal cost, weighting it on profitability, right? And you probably noticed like the NASDAQ has done way better than the S&P 500 over every time period. There was like one time period it didn't do better. And it was like in the 2000, right? 2001 to like 2003, things like that. And like, what was wrong with it then? It was all these unprofitable companies. So I think like the NASDAQ doesn't look like that today, but I think the problem with some innovation and growth funds, like ARK, is that like so much of the portfolio is unprofitable. And like, that's like not, the way you mess this up is you have all these unprofitable names that in a downturn lose 80% or something, and that's not good. And the other way you mess it up is by putting all your eggs in just a couple baskets and like you pick the wrong ones. So I think like AOTG is a diversified fund. It weights not just on market cap, but it weights on these other factors. And like when you go through like the top holdings of the names, you're going to find that it's like really compelling, right? Like on SCHG. So I pulled up some of these. Like AMD is a top holding for AOTG. It's growing its earnings per share at 528% year over year. And you're like, well, that better be a big weight in SCHG too. And you're like, no, it's under 1% because they weight on market cap. And then like Toast is growing their earnings per share. Also another top holding in AOTG over 7%. it is a large cap company. You would hope that it's a big weight in SCHG, and it's not. It's at 0.07%, right? And then Robinhood is another one at around a 7% weight in AOTG, growing its earnings per share at over 105%, while it's only a 0.25% weight in SCHG. So you do the math on these, but you realize you have a portfolio that's earnings growth is multitudes higher than the index. And the price, get this, the price to book value, you're like, oh, well, you're probably paying higher valuation metrics. The price to book value on AOTG, looking at like the Morningstar, it's cheaper. So like that's like the really cool part that you could really believe in the long term that this is a good strategy. In some ways, you're paying lower metrics for multitudes higher growth, and like that's really like the mathematics behind this.
So the main methodology is looking for those high quality growth names, those growth stories, low marginal costs, and of course, fast and compelling earnings performance from these companies. Is that correct?
Yeah, and I can go a little deeper into the low marginal cost and explain like why there. I think the problem with just focusing on technology is it doesn't explain actual technology, right? So like you're like, oh, I own a technology fund. I wonder how much Google I own. And they're like, oh, nothing because Google's communications. And you're like, wait, like this is literally, you're like information technology. It's technology I use to find information. So the GICS classification code is like wrong. And that's why I mean, whatever. Maybe it's not wrong, but like Amazon's not technology, Google's not technology. I think that's why there's more of a focus on Mag 7 because people are trying to capture this big tech without calling it big tech. And so like AOTG focuses on it's a diversified fund, but it uses this low marginal cost, I think, to target what I think is, I like to call them software platforms, which is basically they're software businesses that have zero or they have very low marginal costs. They can scale, they can achieve very high growth. You take this approach and you just include all the businesses that qualify, whether it's Robinhood or Visa, right? Because really at the end of the day, Robinhood is like automating through software brokerage services, just like Visa is automating payment processing. Like, so you don't have to go to the store and like do a wire transfer every time you want to buy groceries. So enormous value they provide there. And it's just a very, very exciting time. And we haven't even gotten into like the most fun part of like AI and stuff. So
in terms of the overall investment objective, so from what I'm hearing, it's, a true growth and innovation ETF, as well as, hopefully outperformance. Is that correct?
Yeah. A true growth and innovation ETF. It's the only ETF in the market that uses this low marginal cost targeting to help weight the portfolio. And the other thing it really does is it focuses on profitable companies. So 99% of the portfolio is profitable, which I think takes a lot of risk off the table in some ways. And like if you look at the S&P 500, the last stat I saw is only 4% of the S&P 500, or I'm sorry, 94% of the S&P 500 is profitable. So it's a more profitable portfolio, I think, as a whole.
ARK, that ticker, huge run up, I believe, in like 2020 and 2021. I think it was like ETF of the year, but there was a lot of skeptical investors, even myself, looking at like the names, volatile, maybe unprofitable, and we saw the performance after that. But with AOTG, you're telling me more profitability, higher quality names, and that's kind of what led to the great performance of AOTG to outperform big institutional money, VUG, SCHG, XOK, etc.
Yeah. I mean, it's all about creating that ability to have really high earnings growth. Because at the end of the day, stocks are going to be correlated in a portfolio to based on how much it's growing, right? So like you have like the S&P 500 companies, I think are growing their average earnings at like, 4 or 5% year over year on a weighted. And like AOTG, like we just went down the top holdings, you're seeing they're all growing at, 100 to 500%, earnings growth year over year. So you're creating like really, and I think the most compelling thing is companies that can grow that fast are obviously providing a lot of value, like in ways that is just like, I mean, it's the best way to quantify that the market is assigning their products to be very innovative and very valuable. Yeah, you're targeting these companies that have the ability to grow their revenue at 20% or 50%, but because they have 100% or close to 100% profit margins on additional sales, you can see 100% plus back-to-back years of earnings growth like that. And then these companies at the same time, like now I think what's really shifting in the story with AI, you're seeing that there's a really, like tech is always kind of like growing their earnings out of control. I'm sorry, not the, and they've been growing some of their expenses at times is out of control. But now for the first time, you're really seeing a very like strong focus on controlling expenses and in some cases even reducing headcounts and reducing expenses. And so some of these companies that I think were the early leaders like AppLovin and Hood are up 304%, 400% on the last year while maintaining and even accelerating their revenue growth and just leading to unprecedented, like unexpected levels of profitability. So I think it's nice in this rally too that it's really being backed by profitability and earnings growth. These companies are bringing home like the cold hard cash, which is good for investors.
When you think about the typical investor for AOTG, what investor is AOTG for?
AOTGs for that long-term buy and hold investor. That's the way I own this fund myself. Like I have this fund, I have a lot of confidence in it, and I want to buy and hold AOTG as long as possible. You know, you're relying on me, the fund manager, to stay in the best growth and the best low marginal cost, and then to ride that as long as you can to stay in that innovation wave, which I think is accelerating as software development costs fall. So I think like the past 3 years have been great, and I'm really optimistic for the future. It seems like it's brighter than it's ever been.
Other growth or even like institutional growth or momentum ETFs, those are, we could argue, passively managed. Now,
Yeah.
AOTG is an actively managed fund. So my question is, what is the benefit for investors who want to generate alpha? Because I went to a couple of conferences and it's super important if you want to generate outperformance to have a more actively managed fund like AOTG.
Yeah. I mean, I think when you're picking an actively managed fund, it's really important to focus on like the strategy because you want the strategy to be repeatable. So like in an actively managed fund that like the manager's like, well, I'm going to buy low and sell high. You think, well, that's not repeatable because there's a chance you can't do that every time. Now there, like my strategy is 100% repeatable, right? Like it's not necessarily rocket science, right? Low marginal cost. They're growing their earnings really well, right? They're profitable. I think that like this is a very repeatable strategy, and it's not geared towards high portfolio and turnover either, which I think can be risky. It's really geared towards the portfolio as much as possible, buying and holding for the long term.
AOTG has about 60% of the ETF in its top 10 holdings. Can you walk me through why AOTG is very top heavy in the portfolio? Is it for outperformance? Is it because you guys really believe in the top 10 holdings?
So it's actually a diversified fund. So it meets like more stringent diversification like requirements than like the NASDAQ, because the NASDAQ I think has to have like the top weights over 4.5% be under 48%. Now the rule I have to meet is 5% plus holdings have to be under 25%. And now that is when I do rebalance. So like when I rebalance quarterly. Now, when you get a lot of companies that are going up tremendously, right? Like I haven't done the next rebalance yet, but you can see that big weight, like, a lot of these names are doing very well. So those weights continue to grow. And then the nice thing is you're taking these big gains you're taking and you're reinvesting it into the next best growth. And you're always staying in that while keeping like a weight in that, but you're lowering it a little bit to meet the diversification requirements. But I like the fact that you can be diversified, and I think it makes it a long-term, more compelling investment.
The top 10 holdings, we got NVIDIA, Toast, Robinhood, AMD, Microsoft, TSM, Amazon, Google, Salesforce, and NU Holdings. I want you to walk me through which ones are your favorite names and why you are so compelled on their growth story and why you guys have them as the top holdings in the portfolio.
So, I mean, I'll first hit on like Apple's not in there, right? Which you'll see at the top of other ones. And it's because it's not growing, right? So why waste 10% of your company or of your portfolio in a company that's kind of stagnant, right? So that's out. And then like, obviously NVIDIA, I don't know how well you know like these CPU, GPU chips, but like a CPU can only do one single task at a time. So like if you have a data center, they're only doing one thing at once and the whole data center might only be 5% utilized, but every chip is running a task. Now a GPU can multitask. So like imagine this, a data center can do 20 times the amount of work for 1/20th the space, right? So like think about that, like how much electricity you save, how much construction costs you save. I mean, you save hundreds of millions just on like the wiring alone of the servers. And so they provide so much value. You'd be crazy today, one, to build a data center with CPUs, but also you'd be absolutely out of your mind to not replace a CPU data center. And so like right now we have the GPU data centers being built in the US, but the rest of the world is lagging behind. And so we have tremendous investment that's going to go into this in the next couple of years. I was listening to the All In podcast. I don't know if you listened to that. And they're like, Jensen, like this is like this last week, I think, not even a week ago. And they're like, Jensen, what do you think like the future of NVIDIA? Like, what do you think like in the next couple of years, what the revenue is going to be? He said over $1 trillion a year. Okay. So like right now, I think they're earning like 170 billion or something a year. So like he's talking about like 6x growth. And you have to remember this growth comes at very high profit margins. So like when you start talking about NVIDIA, but also AMD, because AMD also makes GPUs and they're growing their GPU business at 55% year over year. We're seeing tremendous acceleration in their revenue growth. They went from like 0 to 35% because their CPU business is kind of like on the way out, but the GPU business is rising. And so now that growth is finally being offset and we're seeing strong revenue acceleration. And like I said, these companies are doing it with unprecedented levels of profitability. And that's just really good. And like you think like even 3 years from now, like $1 trillion of revenue, like what's that look like in terms of earnings for NVIDIA? And you're like, well, if a company's earning 500 or 600 billion a year, that's going to be a good thing to hold. So that would be, it's never occurred in the history of the planet, but I'm not going to discount what Jensen's saying and think it's not possible. We go down the list, man. Like, so like my favorite holdings you can see are going to be like the ones that are most overweight versus the index. So like Toast, Hood, like Toast. Like let's talk about this one for a second. So I think what you should hold as an investor is companies that create a lot of value for people, right? But I think once you have ones that are creating a lot of value, and like you go around any restaurant, right? You're seeing the Toast hardware, you're seeing the Toast payment processing, you're seeing the Toast like, hey, well, you've got your reservation like coming up in a day, like click here to confirm. That's Toast. So they're running they're doing all the software, all the staffing, all the payment processing, you know, so it's like a comprehensive restaurant management software. But they save a lot of money because they even saved the restaurants money on payment processing. Like if they didn't go with Toast, they'd have to pay Visa more in credit card fees and things like that. So it's like a restaurant that actually, it's like a software that not only saves them money, it also helps them make more money. So like, why would they not use it? And that's exactly right. Like, why would they not use it? And so now you know that they're growing really quickly because it'd be crazy to not use it. And then you're like, well, you know, it looks like it's at all the restaurants. Like, how much better could it possibly do now? And you're like, well, a lot, because if we know anything about American software, it's that they build it in the US and then they sell it at the rest of the world at 100% profit margins. So now Toast is just beginning their international expansion. They're just in the early stages of it. And like, how much more is Toast going to earn in 3 years? Like, I don't want to throw out big numbers, but it's going to be enormous and I'm going to be there riding that wave. So you think of me when it's, when Toast is like way higher. And I think like Toast is already up like almost 100% in the last year too. So I've already been riding the wave and I'm going to keep doing it with AOTG. Then like Robinhood, right? So this one's an interesting one. And, you know, all these to me are software companies, even AMD, but like I know they monetize their software through selling their chips, you know, when the software comes free on it, or like Robinhood, they're making their money through other ways, whether it's like their credit card or whether it's like investing like the people's cash in a money market and earning that. You know, I think what's interesting about Robinhood is like they're a very innovative company, so you should never count them out. Like they're tokenizing stocks, which is like, I don't know, like if I wanted to go buy a company on like the Milan Stock Exchange, it's very difficult for you to do that as like a retail investor. Like let's just call it impossible, right? So like this is the problem. Like you may have a lot of Italians sitting there in Milan being like, man, I wish I could buy Toast, and they can't. And now Robinhood's going to give them a way to do it. And you've got 1 billion people in Europe. And so I think that that's like very compelling. I think that like the cross-border, like breaking down those barriers of cross-border investing that they're doing is incredible. They're also growing their revenue at 50% year over year already. And they have, I think, 105% earnings per share growth. So like this is a very successful company. Like I'm watching like shows and everybody's holding up their like Robinhood. They're all holding up their Robinhood gold card. Like this is my gold card. I don't have one yet. I can't believe that. I'm like going to reach out to them, but they're all holding up their gold card. And like these people are like billionaires on the show and like they're using Robinhood and like my neighbors are using Robinhood. And I'm like, they must be finding a lot of different ways to provide value for different types of people in a way that we've never seen before. Because normally you've got the wealthy people, their private wealth management, and you got the retail investors with their specific app. So I think they're a very innovative company, and obviously the revenue and the earnings growth is there too. So instead of having it at like a very small weight, like an index, like SCHG has it at a 0.25% weight, I have it at close to a 7% weight instead. The Mag 7 is really interesting. The ones I own, like Amazon, that as we go down that list, Microsoft, they're reducing their headcounts, right? And they're controlling their expenses really well. At the same time, their revenue growth is accelerating, and I think a lot of that is due to AI. So like an analogy I like to give for Microsoft is that like no like most people don't use their Copilot, but like you go to the big cities like New York City. I'm at the NASDAQ exchange last week, and everybody's like, I love Copilot. I couldn't live without it. And like these are the early adopters, and Copilot costs like 5 times the amount of Office as their Office suite costs. So like if they just sell 20% of businesses across the world on Copilot, like you're talking about revenue growth that would be gigantic and profit margins that would continue to expand like nobody expects. So I think that there is some very big upside in these companies, and any company that can control their expenses while they're growing their any low marginal cost company that's going to control their expenses as they grow their revenue, like and accelerate that, I think you're going to see that the future is going to be very bright for them, and they're going to continue to surprise to the upside. Because a lot of analysts are just like, like think about NVIDIA 3 years ago. You know about the GPU, but an analyst is sitting there like, I can't say they're going to earn 18 times more in like 2 years. Why don't we just put something reasonable like 1x more? And so in these low marginal cost companies like that, that's not how things have worked historically. And I think they're consistently underestimated. And that gives you as an investor in AOTG or in these stocks yourself a pretty good competitive advantage if you plan to buy and hold them for the long term.
When you think about rebalancing, how do you go about rebalancing the portfolio, whether it's adding new positions or cutting out of positions or making sure everything is following your guys' probably like rules-based strategy?
There is some flexibility. So unlike an index that is like very stringently like rule based, like you can provide some like I was in AMD last year when it wasn't growing their revenue, but I could tell that like their GPU business is growing at 100% and their CPU business is minus 50%. So like they look like they have no growth, but you're like, wait, if I wait this thing out for 1 year, we're going to see very strong revenue growth acceleration. And then we did, and then the stock goes up quite a bit. So like I think the nice thing about active management is you can make some common sense adjustments like that to kind of read the earnings and see which way the winds are blowing. I mean, I think the biggest thing is companies that aren't growing their revenue and aren't growing their earnings. It's also a sign that they're kind of not innovating also. Like they're not continuing to provide more value. So those are companies that sometimes you get disappointed by and you take out of the portfolio, but you make sure you replace them with the best ones. Like maybe there's a new IPO like Figma, or maybe there's like, there's new companies that come in, and there's also companies that continue to surprise you in new ways, that you can add bigger weights on. So I think that's the way I take a look at rebalances. And then the other part of the rebalance is staying diversified. So sometimes you have to cut even off of your favorite names, but it's to reduce the risk in the portfolio. And you can do that while still being able to add upside a lot of times.
How will you manage the portfolio in the event of a bear market or a recession? Are you going to keep the same names? Or are you going to add more like value-oriented growth stories?
I've already been through these, right? And like we saw some 2022 was negative, and we saw there was like the trade war like in April. So like we did see like bear markets happen, and like what was I doing then? And what I was doing then was continuing to make sure I was just in the best earnings growth. Because at the end of the day, there's nothing safer than knowing the companies you own are growing their earnings at 100% year over year. Because you're like, if the stock went down 50% and they grew their earnings at 100%, they're trading now at 1/4 the valuation metrics that they were the year before when you add those two things together. So you think that's pretty unlikely. Like if I can get that good earnings growth and keep the valuation metrics reasonable in the portfolio, that's going to provide me a lot of protection on the downside, and it's going to keep the upside on the table. So that's the way I do it. I mean, I don't always like to look at like the portfolio betas and stuff, because like you have a stock that goes up 50% and you have a stock that goes down 50% and they have the same beta. And you're like, wait, there wasn't like risk in this one, but there was risk in this one. Why do they have the same beta risk? And so I don't like to look at it that way necessarily. But I mean, just staying in the large cap, profitable, low marginal cost companies that are continuing to innovate and grow, I think that creates a really compelling safety net.
I guess, how did you feel, or did you foresee that your fund, AOTG, was going to outperform the S&P, the Nasdaq, and it's just super unique to see a new fund manager like yourself come out and provide value and innovation in the growth ETF space, especially with AOTG providing outperformance to investors.
Yeah. So, I mean, launched this fund because I wouldn't have done it's expensive and it's time consuming to do this. So, like, I wouldn't have done this if I thought I could have bought the VOO and did better, right? Or the SCHG. So, like, I did this because I was trying to like maximize my own performance and do that for other people as well. And like, I wouldn't be there to like recommend something to somebody that I didn't think had the potential to do that. So, or myself, right? So like, so yeah, I thought that was a pretty strong possibility. Like I said, I was doing this before this in SMAs, so I did like have some confidence in the strategy before it was public. AOTG launched and like it was started trading in the 24s and now it's in like the 52s, right? So like it's gone up a lot and like it is like close to doubled the performance of the S&P 500. So that's been a really nice validation though to say like when you put it and you take the strategy public and you have this AOTG ETF that it continues to shine. So
How should investors react in a bear market or even like yourself managing AOTG? Because okay, I wouldn't say this is a bear market. Let's see a decline in the market, a sharp decline. We all know what happened back in March and April. We saw AOTG have a great performance, and then it kind of dipped a little bit lower than the indexes. And then once everything happened in April from the huge bounce back in the market, AOTG just shot up and it was
yeah.
like back on to outperforming the S&P and the Nasdaq by a huge margin. How should investors react holding a product like this or even in their own portfolio with highly concentration into growth and tech names?
Basically to have confidence in what you're doing, right? So like the worst thing you can do is sell, right? Like, so like the market goes down 30% and you're like, oh my gosh, like the world is ending. Like the tariffs are going to destroy the whole US economy. I'm selling everything and going to cash. So like when you have a strategy you believe in the long term, that gives you a really big competitive advantage, even over to the people on Wall Street, because a lot of those people are leveraged and like they can't hold forever. Nobody can force you out of an unleveraged fund, right? Like you can just buy and hold this thing forever. That is like your competitive advantage is somebody that's not like institutional, is that you have a long-term horizon and you don't ever have to panic. So like I don't think people should overinvest like the money they need to spend on groceries next month or something, right? Like so you shouldn't like be putting yourself in that position. But like when you do have your pool of money that you're investing for the long term, like just know like the stock market historically has done very well and it doesn't make sense to sell during pullbacks. That's the same is true for the large cap market. It's the same is true for the technology market. The same is true for the growth market. And that's what this fund really like focuses on. And like the way AOTG like beat the S&P 500 and the way it beat the NASDAQ 100 is it kind of focused on why those funds did well and it focused on them in greater detail, right? So like it said, oh, like we can tell that this portion of the S&P 500 did really well and this portion of the NASDAQ did really well. Why is that? It's that growing low marginal cost business. Let's hone into this on even better detail, on even better focus and use this to beat both of them. And so like, if you have confidence in that strategy, then you should continue to feel confident in it, even over a rough patch. Because at the end of the day, there's always going to be ups and downs, but what matters is the long term.
I guess generating alpha and outperformance. We've seen large cap tech perform better than the S&P. So let's say you buy a large cap tech ETF, you would have outperformed it. Let's say a momentum based ETF. Those, in my opinion, are like chasing returns,
Mhm.
and you're kind of just like writing like momentum names that did well. And then your fund is looking at high growth, high quality, high earnings names. I guess we could argue a momentum ETF, a growth ETF, that is your guys' ETF kind of having a better competitive advantage versus other institutional funds?
So, I mean, I think the thing about momentum is like most of the companies that did well the year before actually like had good earnings growth. They're targeting stock-based performance that is correlated to actually good performance in the company, right? They're kind of missing it because they're not targeting it directly. You know what I mean? So like there's a chance when you have this momentum fund that like you miss like 20% of them are just like the retail, names that are shooting up like AMC, and next thing you know, you've got a bunch of it in your portfolio, and it's like not a good idea to be doing that. So like why, like we know that like they're targeting this because it's correlated, but like you're not actually targeting the factors directly. So like I think like when you think about this like in the long term common sense, like me, like well we know why we know why the momentum funds did better, but they're still not directly correlating it. And you could probably do better. Nobody can tell the future, but I think I would bet a lot of money that you would do better than the momentum funds if you target it directly instead of indirectly to factors. And so like that's like the biggest thing for me. And some of those momentum funds are, by the way, like they're interesting, but every one of them has different rules. And sometimes they do terribly, and they're all over the place, the performance. Like some of them do well, some of them do terribly. And so like you really have to deeply understand like the rules of each one. When you invest, you want to invest for the long term. So you don't want to be like, this is a great idea, and then 6 months lose confidence in that and sell at a bad point. So like, I think any investment you go into, you should have a compelling reason to, if things go badly, like what's the plan? Do I get out or do I continue to believe in the strategy? And I think it's best when you can continue to believe in the strategy. So it's best to do that homework on why you think it'll be good to hold, even if it has a sharp pullback.
What's one common mistake investors make when investing in AOTG or even growth and momentum ETFs?
Well, because it's trading like at record highs, I don't think they've ever made a mistake in AOTG yet. But I mean, I think the biggest thing investors make, like retail investors, is that they come into the market. And first of all, I think there's like a attraction towards value, right? All right, so I'm going to say there's three things. There's a value skew. There's when they trade on margin. I think that's like pretty risky also. And then the last thing, or I'll hit the value one first. So like they want to buy what's cheap, right? So they look for like something that has a PE ratio of 10 and it looks like it has like a 7% dividend. But like the problem with these cheap companies is like a lot of times they're not doing well and there's a reason why they're cheap, or there's no growth potential. And at the end of the day, like 5 years from now, if you're going to make money in your investments, the company has to be more profitable, generally by quite a bit more profitable than it is today. And so if you're buying a company that's shrinking, there's a pretty good chance that's not going to happen. So like that's the first trap. The second trap is the small cap trap, which is basically people are like, well, a big company can't continue to grow, and they said this about Microsoft and Google. They're like, oh my gosh, $100 billion company. They'll never be a $1 trillion one. It's not possible. And then they're trillion. Then they go, well, they'll never be more profitable than this. And there's no way they can grow. And then they're 4 trillion, right? So like, on the flip side, these people say, well, if I buy a really small company, like $100 or $200 million market cap, this has a lot of room to grow. And so you take a look at like these like companies, and by the way, a lot of the small companies are like advertising for like positive like news articles. And so they kind of like trick people too, where like this isn't like real news that they're picking up. Like this is like going to cure cancer next in this biotech company. Like it is kind of like fake paid placements. And so like these people, like they're buying these things they think are going to do really well, and then they don't. And like they lose everything because like they were unprofitable to begin with. And I think that's another trap, the unprofitable company. Like they have this whole portfolio, and you talk to retail traders that did badly in like 2022, you ask them what they held and they were like all unprofitable companies. And you're like, that's not a good way to build a long-term portfolio. And then like this in the small cap space, again, the stock-based compensation, especially in tech, is like totally out of control. You're like, the people at Google are making $200 million a year. That sounds like a lot, but I guess they do run Google. You're like, what's that small company? What's their executive team making? And they're like, oh no, they're making $200 million a year also. And you're like, what? Like that's like 30% of revenue. And they're like, no, yep, that's what they're making. And you're like, but that leaves no upside for like the investors. And they're like, yeah. And there is economies of scale in this. And there's economies of scale when the companies are big and they're doing buybacks. So like, I think it makes sense focusing on large cap, growing. Like it doesn't have to be technology, because like I've said, like my definition of technology is actually a diversified fund. So, but that low marginal cost. And like the last one is basically like trading on margin. Like when you trade on margin, I think a lot of initial investors have like this, like when something drops, they want to buy more. So like you're 3x leveraged or whatever, the market drops. And now you lost 50% of your equity, right? So now instead of having $100 of equity, you only got, 50, but you still have $100 lent from the bank. So now you're like, I'm sorry, 3x leveraged, but you still have $300 lent from the bank. So now you're actually 6x leveraged. And their response to that is, well, now the market drops, so I'm going to buy more. And all of a sudden they're 12x leveraged, and they blow out. So like, I think it's probably best, especially in long term, not to do that. Or if you're going to do that, you have to understand you have to sell on every down day and buy on every up day. So you're always selling on the way down to keep the leverage constant and buying on the way up. In leverage, and like I did come out with like SOFL. It's a 2x leverage daily software platform ETF. And that was like kind of a way to do this as a better way for retail investors with lower borrowing costs and better professional management of the risk. So I think that's, there's a couple of traps. Hopefully I didn't go into too much detail for you.
When we're looking at allocating AOTG in a portfolio, how you're seeing your clients and investors have AOTG in a portfolio? Is it their core position? Is it their growth or technology replacement? Is it a complement to a well-diversified portfolio?
I think in some cases it's a replacement for the S&P 500. Some cases it's a replacement for the VOO, or or like a growth fund. And in some cases it's like a core, portion of their portfolio, because some people really believe in this fund and they believe that this is like a good way to outperform the indexes without taking too much risk. I think that any of those work, and like for every investor that comes on board, like it's always an honor to have every person in there. And I like making, money for as many people as possible and helping them achieve like, their financial independence in the way that they dream of. So it's really a pleasure to be able to be there for retail investors and have this strategy be public.
Any new ETFs on the horizon?
So I have AOTG, which is always going to be my flagship fund. And it's always going to be what I, hold the most of personally. I also have like this new fund, SOFL, that just listed on the New York Stock Exchange. And we're actually excited. We're going out to ring the bell. What I do is I really want to push the bounds of what's possible in terms of performance. So I only want to come out with funds that I want to own myself and buy myself. And sometimes it doesn't make sense to have, well, I've got my fintech exposure, my genomic exposure. I mean, it gets too complicated. I like having like a portfolio that has like 2 or 3 or 4 things. And so like I don't envision like having a lot of funds unless somehow there's like a new factors I realize I can target to really good investment performance. And so that either comes, I mean, we'll see what the future holds. You can never really tell these things, but for now I don't have any funds on the horizon. I'm just focused on doing really well for the shareholders and being able to create a lot of value for everybody.
When we're thinking about investors who try to outperform the indexes, that's a hard task, but you did it with AOTG, and you have a great background, University of Oxford, Northwestern, correct?
Yeah, Northwestern.
Top universities that are nearly impossible to get into, and you've done all the research, you've done your time, and you're outperforming the indexes. What are some tips, non-financial advice for investors who are beginners, retail investors who want to outperform the indexes?
Yeah, so I mean, the biggest tips are probably like do your research on what's done well the past 5, 10, 20, 30, 40 years, because you're going to realize it's the same stuff that's done well. And there's no reason to like reinvent the wheel. Like you can pick up on like why these things have done well. And that's what AOTG really does focus on. So like I practiced this myself and brought AOTG to the market because I didn't think there was anything in the market that that does it the same way. But like I said, focus on profitability. Focus on large cap, focus on growth, and focus on either low marginal costs or technology. And I think that's like a winning formula for the long run. And so, it'll be really exciting to see where this goes. And it'll be a pleasure to have some of your viewers hopefully, join the fund and join this journey with me. And you, I think too, maybe. So thank you.
I'm even a little bit inspired by your story, AOTG. You're a younger fund manager on Wall Street in the market. You are outperforming the indexes, providing value for investors. So any last words or wisdom for beginner level investors who are watching this video, looking at yourself, hearing your story of investing, and that might, I guess, want to be in your shoes, whether it's outperforming, whether it's starting an ETF firm, or whether it's just even getting started with investing?
Yeah, so I guess it's always about trying to learn as much as you possibly can and always being open to learn more, right? So that's like the first thing. And like you can learn more about the AOTG ETF at AOTETF.com. The next thing I think it's really important to keep in mind is just like understanding that like the winds are always changing. And so in investing, like it's good to go and read through all the financials and know as much as you can about the companies. And it's nice when you've been doing this for a while, like for decades, because then you kind of have that encyclopedia in your head of the past and you can envision the future. keeping your eye on that change, whether it's like the GPU change or whether it's like the software automation change and how costs are coming down and innovation is speeding up, but making sure you position yourself well, not to just pick a few names, but kind of pick all of them so that you don't get it wrong and keep your wind and keep your little sailboat. You've got a sailboat, keep your sail all the way open, positioned to catch that wind for when it does blow. Because like that is like understanding the big picture a lot of times is more important than understanding the small picture in investing. And it gives you confidence in the long run too, of like, the market goes down and you think, well, you know what? It's fine. Like I remember in 2022, all the semiconductors were like everybody's like, there's a semi glut, right? And like, I'm thinking there, I'm like, every car is supposed to be self-driving. Like every phone is supposed to run on 5G. Everybody's backing up their Ring doorbell and their 200,000 iPhone photos. I was like, it sounds like we're going to need a lot more chips in 3 years, despite what these like people keep blasting on 2022 about the chip glut and Nvidia's down 75%. And then we did. And like sometimes the narratives get overblown. So just using some common sense and thinking for yourself and being able to and being able to pick up on those wins and not panic at times of panic, but stay strong in your strategy, I think is just so important.
Thank you so much, Mr. John Tinsman, the CEO, founder, and portfolio manager of AOT Invest. Now, once again, guys, I want to say congratulations to you, John, for a great fund. It's a great story. And if you guys like this video, please give it a like because this Q probably did. And don't forget to check out our last ETF interviews right here on your screen. I love you guys so much. Crush it in the stock market and take it easy. Peace.